Shares of global industrial firm CNH International hitting a 52-week low today after the company lowered its full-year guidance in its third-quarter earnings report. The move comes as the company sees softening market conditions in South America. Joining us now is Scott Wine, CEO of CNH International. Scott, it's great to have you back on the show.
Hello, Morgan. Good to see you. Thank you for having me on.
So lowered guidance. You also announced a restructuring plan as you've seen demand for farm machinery slow. It's essentially been a perfect storm. You've got higher interest rates, you've got lower commodity prices, and then you have this normalization that's happening after all the supply chain bottlenecks in order backlogs and dealer inventories. Does it get worse before it gets better?
No, Morgan, actually, the fundamentals in agriculture still remain really good. The problems that we had, if you call that, I talked, about disappointing results, but really it was driven by the South American market, specifically Brazil. And I was down there recently and just talking to the farmers. They've had a lot of the input costs they've had this year are much higher than they expected. And then as soft commodity prices, grain, corns, whatnot have come down, they're just reluctant to sell. So they're actually a little bit short on cash right now because they're not selling their grains. And that's not going to last forever. They're ultimately going to sell and ultimately buy equipment. But, the fundamentals in South America specifically are as good as they've ever been. It's just a weakening time in the market right now. And we're really trying with higher interest rates to protect dealer inventory. We took down dealer inventory sequentially in Brazil, so they're very lean from that standpoint. So when the market recovers, we'll be very well positioned to increase our sales, where we've got our highest market share positions in South America. So we think fundamentally we're in good shape, but trying to react to a slowing market as quickly as we possibly could.
Okay. If we look beyond South America, take me on a trip around the world, since you do sell into so many major markets across the globe. In North America, it looks like industry volume was up 19% year over year. What are you seeing across the continents right now? And what is it saying about the state of the economy?
Well, thankfully, we trade more on the ag cycle than we do economics. So if there was a recession necessarily, we would trade more on where the ag cycle is going. And right now, the fundamentals in cash crop ag are still relatively good, specifically in North America. I was just with the CEO of Titan Industries, our largest dealer today, and they were just talking about how many of their product categories they're still trying to be able to catch up with the demand that they're seeing from their customers. So, we feel like North America is still quite sound. Dealer inventories are in better shape, so there's really not as much room to channel fill, but we think fundamentally the demand is good. Asia Pacific, Chunwei Ter and our team over there are doing an outstanding job, and that's been reasonably good year to date. Europe, we're seeing a little bit of slowdown in Europe, but certainly it's just a slight slowdown, not a dramatic downturn. So I think we're in reasonably good shape there. And then our business in South Africa has also been relatively strong this year as well.
Okay. You also grew margins, and you did announce, and you've already been cost cutting, but you announced a broader cost reduction strategy. You're going to reduce some of your headcount as well. How meaningful is that going to be to the story moving into 2024?
Well, we talked earlier in the year that, if 22 was about price, 23 was going to be about cost, and we've been really aggressively moving after that. As you know, we spun off our truck and engine division a couple of years ago, and we've had a couple of years now as a standalone ag and construction business. And, as we've done that, we just see an opportunity to be more efficient in a market that might be slowing. So I don't want anybody to think we did this in reaction to a slowing market, but just how can we be better for our customers, more agile, and really create a better work environment for our team, although it'll be a little bit smaller team going forward. But, we see this as an opportunity to just be a better company, and that it's the right time to take this action.